Have you ever wondered how Warren Buffett and Charlie Munger built Berkshire Hathaway using their unique investment strategies? Well, if you're keen on understanding the magic behind this mammoth of financial success, you're in the right place. Investment strategies are like the compass guiding a ship through the vast ocean of financial markets. They provide structure, discipline, and a roadmap to navigate through the ebb and flow of market trends. A well-crafted strategy is instrumental in achieving financial goals and mitigating risks. It is the backbone of any successful investment journey, and the one used by Warren Buffett and Charlie Munger is no exception. Take a moment to think about Berkshire Hathaway, a conglomerate that started as a textile manufacturing company and is now home to over 60 companies with a staggering net worth of several $billion. This colossal success wasn't achieved overnight. It's the result of a carefully crafted and consistently applied investment strategy. Now, the masterminds behind this success are none other than Warren Buffett and Charlie Munger. These two financial wizards, with their unique investment strategies, transformed Berkshire Hathaway into a powerhouse of wealth creation. Buffett, the Oracle of Omaha, and Munger, his right-hand man, have been the pillars of Berkshire's success story. Their strategies, deeply rooted in principles of value investing, management quality, and the buy-and-hold philosophy, have consistently delivered impressive returns. They are not about chasing quick profits or getting swayed by market trends. Instead, their approach is about understanding the intrinsic value of businesses, investing in competent management, and holding on to investments for the long run. As we delve deeper into this video, we'll be unpacking these strategies one by one, revealing the secret sauce behind Buffett and Munger's success. We'll explore how these strategies have been instrumental in building Berkshire Hathaway's empire and how they can be applied to your investment journey. So whether you're a seasoned investor or just starting your journey, there's plenty to learn from these investment gurus. Stay tuned to learn the secret sauce of their success. Buffett and Munger follow a strategy known as value investing. But what exactly is value investing? Well, in its simplest form, value investing is a strategy that involves buying stocks for less than their intrinsic values. This intrinsic value is the actual worth of a company, taking into account all tangible and intangible factors. It's a bit like hunting for bargains at a yard sale, except you're doing it on the stock market. The value investing strategy was popularized by the legendary investor Benjamin Graham, who happened to be Warren Buffett's mentor. It's based on the idea that the stock market, being driven by human emotions of fear and greed, often misprices stocks. This mispricing creates opportunities to buy great companies at discounted prices, or in other words, at a value. So, how do you find these undervalued stocks? Well, value investors like Buffett and Munger look at a company's fundamentals. They analyze financial statements, assess the company's debt levels, and evaluate its earnings potential. They also consider factors such as the company's competitive advantage, industry position, and the quality of its management. But value investing isn't just about numbers, it's also about patience and discipline. You see, undervalued stocks can remain undervalued for a long time before the market realizes their true worth. That's why Buffett often says, the stock market is a device for transferring money from the impatient to the patient. Buffett and Munger have used this strategy to identify undervalued companies and make some of their most profitable investments. For instance, they saw value in American Express when it was struggling in the late 1960s, and in Coca-Cola when it was out of favor in the 1980s. And we all know how these investments turned out. So, value investing is all about finding hidden gems in the market. It's about buying dollar bills for 50 cents. It's about being patient, disciplined, and sticking to your principles. It's about investing with a margin of safety, reducing risk and aiming for long-term growth. So, value investing is all about finding hidden gems in the market. Buffett and Munger don't just look at the numbers, they also consider the quality of a company's management. Why is this important? Well, let's dive into that. Management quality is vital in investment decisions because it can significantly influence a company's trajectory. Good management can drive a company's success, while poor management can lead to its downfall. Think of it this way. A company is like a ship, and its management team is the captain and crew. If the crew is competent, they can navigate rough seas, steer clear of icebergs, and keep the ship moving towards its destination. If the crew is inept, even a state-of-the-art ship can flounder and sink. That's why Buffett and Munger place such a high value on management quality. They look for managers who are not only competent, but also passionate about their work. They believe that a manager who loves their job will be more motivated to overcome obstacles and lead the company to success. But how do they evaluate management teams? They look at several factors. One is the manager's track record. Has the manager been successful in the past? Have they been able to increase profits, reduce costs, or otherwise improve the company's performance? If the answer is yes, that's a good sign. Another factor is the manager's integrity. Buffett and Munger believe that integrity is just as important as ability. They look for managers who are honest, ethical, and transparent. After all, a manager who lacks integrity can do a lot of damage, both to the company and to its investors. Finally, they look at the manager's vision. Does the manager have a clear, realistic plan for the company's future? Do they understand the company's strengths and weaknesses, and do they know how to leverage those strengths and address those weaknesses? If so, that's another good sign. In conclusion, while the numbers are important, Buffett and Munger understand that they're not the whole story. A company's management can make or break its success, and that's why they always take it into account when making investment decisions. Remember, a great company is only as good as its management. Buffett and Munger are notorious for their buy and hold strategy, but what does this mean? Well, to put it simply, it's a strategy that involves purchasing stocks and instead of selling them off at the first sign of profit, holding on to them for a substantial period. This is not a strategy for the faint-hearted or those seeking quick returns. It's a long game, often spanning years, even decades. Now you might wonder, why would anyone choose to hold on to stocks for such a lengthy period? Isn't the stock market volatile? Indeed it is. But here's the thing, Buffett and Munger aren't just buying any stocks, they're buying stocks of companies they believe in, companies they've researched thoroughly and are confident will stand the test of time. Here's where the genius of this strategy lies. When you hold onto a stock for a long time, you're not just hoping for the company's value to rise. You're also reaping the benefits of compound interest. As Albert Einstein famously said, compound interest is the eighth wonder of the world. He who understands it, earns it. He who doesn't, pays it. In the world of investing, compound interest is a powerful tool. It allows your earnings to generate even more earnings, creating a snowball effect that can lead to substantial growth over time. It's how a small investment can grow into a colossal fortune, given enough time and patience. But remember, this strategy isn't about blind faith or wishful thinking. Buffett and Munger don't just buy and hope for the best. They do their homework. They investigate companies, analyze their financials, assess their management, and only then they make a calculated decision to invest. They buy when they're confident of the company's long-term potential and hold when everyone else might be selling in panic. In the end, it's not just about buying and holding. It's about buying wisely, holding steadfastly, and having the patience to let the magic of compound interest do its work. It's about understanding that the stock market is a device for transferring money from the impatient to the patient. Patience, it seems, is not just a virtue, but a key to successful investing. So, what can we learn from Buffett and Munger's investment strategies? Well, they've certainly given us a lot to think about. Let's revisit the main pillars of their approach. Firstly, there's their emphasis on value investing. This is all about seeking out companies that are undervalued by the market. Those hidden gems whose intrinsic worth is greater than their current market price. It's like finding a diamond in the rough, and Buffett and Munger have proven themselves to be master gemologists in the diamond mine of the stock market. Then we have the focus on management quality. Buffett and Munger don't just look at numbers on a balance sheet, they look at the people behind those numbers. They believe in investing in businesses led by capable and honest managers. After all, a great ship is nothing without a skilled captain. Thirdly, we can't forget their buy and hold strategy. Buffett and Munger aren't interested in short-term gains. They're in it for the long haul. They buy shares in companies they believe in, and then they hold on to those shares, sometimes for decades. It's not about timing the market, it's about time in the market. These strategies have been instrumental in shaping the success story of Berkshire Hathaway. From a struggling textile mill to a multinational conglomerate, the company's journey is a testament to the power of smart investing. But let's not forget that it's not just about the strategies, it's also about the mindset. Buffett and Munger's approach is rooted in discipline, patience, and a deep understanding of business fundamentals. Investing is not about getting rich quick, it's about making smart decisions and being patient. That's the lesson from Warren Buffett and Charlie Munger. Remember, Investing is a marathon, not a sprint. So take a leaf out of Buffett and Munger's book. Look for value, invest in quality, and be patient. That's the path to long-term success.